Uh, Greetings to everyone. This week I'm going to try to answer a number of questions that were sent to me, which I originally intended to tackle in tutorials, but I think in the interest of time and also due to the complexity of the subject matter, it may well be better if I do that here. So let me just share these questions with you. The first one, and you will find these questions in the tutorial file, which are due to be presented tomorrow and also next Friday. Okay. Now this is the first question. It's actually the underline, the part that's underlined that I want to answer. From both lecture and tutorial, I'm confused about the difference between martingale and random walk. I don't find clear explanation on the internet. Yeah, this is a little bit like that kurtosis stuff. I think sometimes when you go on the internet, you end up getting even more confused and potentially getting the wrong idea. They are similar concepts. To give a short answer, a, um, a random walk is definitely a martingale, but a martingale may not be a random walk. In other words, okay, so if you have um, a lot of processes, a lot of stochastic processes, and let's say these are all martingales. So maybe a subset within will be random walks. Okay. Now, what actually is the difference? As you know, for martingales, we simply define the expected value of the next, let's just say t plus 1 in the next period, given what we know from 1 to all the way, given what we know now up to this moment in time. So the expectation of the value of the next period is the value right now. That is to say, if you ask me to guess, I don't know. I don't know which way it'll go. This should be x little t. Okay. Now, random walk says something a little bit different. It says that the expectation of the difference between the value of the next period and the value now, okay, the expectation is 0. Now this is actually just this is in a sense a reinterpretation of the formula above. Okay, so if your best guess for the next period is the value now, of course, then you expect the any difference would be 0. It doesn't mean it will be 0. It just means you don't know. So on average, if you were to have this process happening a million times, perhaps half of the time it'll go up, half of the time it'll go down. Sometimes it doesn't change. It is possible. Okay, but overall, when you add up all the up and down movements, you get a net average of 0. That's what it means. Now, for random walk, so this is a martingale. Okay, for random walk, there is an additional condition. Random walk basically. So if you have let's say a price like this, okay. So I asked you, what would be the next price coming up or down, and you say, well, I don't know. So my best guess is, the next price. My expectation is just here, okay. And in addition, I give it some kind of a distribution. So there's a mean around the current value. and then there is a sigma of some kind, and then you have a distribution. So let's say just the real standard normal distribution, and you say that not only do I not know, okay, but so next period, let's say it actually goes here, okay, and then you talk about, okay, what about the period after? Okay, the period after, I have a new distribution based on this point, and the new distribution has two properties. So first of all, the movement of the subsequent period. So this was t. This is t plus 1. Okay, now t plus 2, the direction of t plus from t plus 1 to t plus 2 has nothing to do with the direction from t to t plus 1. So they are uncorrelated, so they are independent. And not only that, the probability distribution of the movement from t to t plus 1, which is this one here, would be the same as the probability distribution of the movement from t plus 1 to t plus 2, which is this one here. This one. Okay, now this is what we call independent and identically distributed. Okay, this is just a way to characterize a random walk, saying not only do you not know where it's gonna go next, they are entirely independent of past movements, and the expectation for the change for the next period is 0, and all these distributions are identical. Okay, so that's the independent, identically distributed variances. Now, this is a somewhat restrictive. So random walk actually, places additional restriction in terms of the distribution, or specifically the variance. Okay, now for martingales, all that we need is this part. Okay, is enough. So the expected difference of the next period is 0. Martingale doesn't say anything about the variance. Okay, now that means let me give you an example. Okay, so let's say so the x-axis is time, and the y-axis is price or return, or whatever you want to. Return might be better. Okay, but it doesn't matter here. Okay, so you have a random process, or I should say a martingale process, and suppose I tell you that right now the price is here, and in the next period I don't know where the price might be, but the best guess is the same price, and then an estimation for the distribution might look like this. Now, if I was to tell you that in the next period, let's say I will use the blue color. Oops, the whole thing changes. Amazing. I want to use a different color, but looks like I can't. Okay, so in the next period, let's say the price drops substantially to here. Okay, now for the period after, if you ask me to guess what the price might be the period after, I still don't know. But now I tell you, well, I think the distribution, the probability distribution for the movement would be different, and it's going to be a lot more volatile. Okay, so you compare the distribution here, so maybe the difference is just a standard normal. Okay, now here it's still normal. Okay, so mean is 0 for the expected change, but maybe now the sigma is up to 2, so double the volatility. Now this actually has I think some resemblance empirically to what really happens in real asset markets. As the price drops, the volatility changes. Okay, and I'm sure those of you who are doing derivative trading would have some exposure on that. Now, if this was the case, you tell me, is this price path or this stochastic process still a martingale? And is it still a random walk? Okay, so that's my question. Now, the answer is it is still a martingale because it satisfies the definition up here. Okay, but it is not a random walk anymore because the variance is now different, so it's not identically distributed. It may be independent, but it's not identical. And is conditional upon what happened in the past. In fact, quite often some exotic derivative pricing models are utilizing precisely this concept that volatility may well change depending on current market conditions, and the model tries to adjust for it in the way that I described to you. So that would be a case when something is a martingale but not a random walk. Okay, so I hope that was helpful. Now for let's have a look at the second question. Okay, and it is this one. You may want to just stop your video for a moment and not only read this question, but think about what the person asking this question actually has in mind. When I first saw this, I was quite intrigued, and I had to go back and clarify with the student exactly what I thought I had an idea what they meant, and then I wrote back and I confirmed my understanding was indeed what they had in mind. So what they're saying is when we are trying to find the optimal portfolio in a case where there are two assets involved plus an additional risk-free asset, so totally three, we normally would just deal with the risky assets first, and then we involve the risk-free asset as a last step. And this person is asking, why don't you involve the risk-free asset right from the start, and would it still work? And how then would you find the optimal investment combination? Okay. Now, this question actually had me thinking quite deeply, and I am going to try to offer an answer here. I think you don't need to know this, but just going through with me is going to help to consolidate your understanding. And it is quite interesting anyway, because it's kind of turning the asset allocation process in its head. Now, what I mean by that is, so let's say I have a return, a risk return space. Now, this is the classical. So let's say I have two assets. One is A, and the other is B. Now, what normally happens when you do it the old way? So as I explained in tutorials last week, so the first thing you do is, as long as these assets are actually less than perfectly correlated, you can draw an efficient frontier, something like that. Okay, and then let's say this is the risk-free rate. So this is the risk-free rate. So in other words, any combination of A and B, okay, if you plot them all out, oops, I'm making a mess of this. If you plot them all out, the risk-return trade-off will be something somewhere along this line. I'm sorry, I'm making this worse. Let me see if I can rub off. Oh, I cancelled it. Okay, just hold on a second. I'm going to draw it back and restart. Okay, so sorry about that. I accidentally wiped out the last diagram. So what you have here, this is the return, and this is the risk, and this is the risk-free rate. Okay, so the process is you first determine when you have assets A and B, all right, what is the efficient frontier, which is the curve here, and then once you have done that, you draw a line from the risk-free rate, which is the tangent just touching. So first is the efficient frontier, okay, and the second point is you draw a line from the risk-free rate, and it should be a tangent just touching that curve. Draw from risk-free rate a tangent, okay, and then this portfolio here, portfolio P, okay, is the optimal portfolio. P is optimal portfolio. Now, what it means, so this is a good time to kind of review what you should already know. So up and down here on this curve, you have combinations of, let's say B. This is where B is. Okay, so ignore this part here. So you up and down this curve, you have combinations where here you are investing 100%, $100 in A, or 100%. So down there you are investing $100 in B, and here I have a portfolio P. Maybe, let's just say maybe, it can be $55 in A, $45 in B. Okay, it doesn't matter. I'm just making this up. Okay, but there's some magical combination which, when combined with the risk-free rate, will give you the optimal portfolio. Okay, now once you have that, then you can go up and down the straight line, otherwise known as capital allocation line or capital market line, if you are actually involving the market portfolio. Okay, so let's say you are risk averse and you decided you want to you are going to park away $20 of your money in the risk-free asset, and you're going to invest only $80 in the risky portfolio. Then what happens is, okay, so $20 in the risk-free asset, and the other 80, all right, will be split 55%, because you want to keep the same ratio of investment. Would be the investment for A, which is what, $44, right? And then the other $36 will be in B. Okay, because that is 80 times 45. Okay, and you go up and down like this, depending on how much cash you want to how much you want to be in cash. So up there, of course, you want to borrow. So you can borrow another $100 if you want. In which case you have $200 to invest, and then you'll be investing $110 in A and then $90 in B. Now, that's the conventional, the classical way of doing this. This question, which I'm now going to try and answer, this question is asking what happens if you involve the risk-free asset right at the beginning. Okay, now if you do that, what would happen is this. So let's say you take the risk-free asset and B, okay, and you want to work with that, and just forget about A for now. Okay, so you just take the risk-free asset and B. Now, your risk-return profile is going to be quite boring. It's going to look like this. It's a straight line. Okay, I'm sorry, I can't. It's hard to draw. It's a straight line connecting the risk-free rate to B. Okay, and now, now what you were doing before was you had a curve to start with, and from a curve, you got a straight line. Okay, maybe I just draw this one more time. And so now I'm going to draw. I'm going to draw this one more time. Okay. So you've got A, B. So this is B, and then before you had the so this is the optimal portfolio, and let's say this is A, and this is B. Now, previously you start with a curve and then you get a line. Okay. Now, what I'm saying here is, if you want to involve the risk-free asset, then what happens is first you have a line, because you are just involving the risk-free rate and asset B. And after you have a line, you ask yourself, all right, this is when I invest 100% in B, and over here is when I invest 0 in B. Now here is maybe when I invest $20 in the risk-free rate, and then $80 in B. Now, what if you don't do that? What if you don't invest $80 in B, but you start mixing and you start introducing asset A into this $80? So maybe it's $10 in A and $70 in B, or whatever. Okay, and then you keep the cash constant. Okay. Now, what happens is, then from this point, you are going to get a series. You're going to get a curve, because now you involve asset A, and the curve will look kind of like this. And then you can go one step further and said, okay, now let's try here. Okay, now here, what is this point? This point is when I invest $50 in risk-free, and the other $50 I will split that so originally I started with $50 in B, but now I'm going to try an experiment by splitting this $50 between A and B. And then because of the diversification, you are going to get a series of curves like this. Okay, and then you can keep going dollar for dollar if you want, and you're going to get a whole load of curves. And each of these, you can see oops, you can see what I'm getting at, I think. Okay, hold on, let me just. So this one would kind of look like this. So with regard to the risk-free rate, each of these curves actually has an optimal point, which is and these curves, they all share a common tangent, and then when you draw from the risk-free rate and you go all the way up, okay, so this was the original capital allocation line, okay, you'd find that this straight line, this will actually touch all of these curves, no matter how small, because they are kind of parallel, if you see what I mean. Parallel is not exactly the correct word. Okay, they're like ripples. Man, it's so hard to draw here. Okay, oh, okay, but you see what I'm getting at. Okay, I should draw this somewhere else and then just scan it. Like ripples. Okay, so you actually end up, in other words, you end up with basically the same result, but with the original way. First, you start with a curve, the efficient frontier, and from there you get the line. Here, if you want to start with a line, okay, you will get back the curves, and with these curves, with each curve, there is actually one point, okay, which is optimal, and they will all share the same Sharpe ratio, which is the highest one. Okay. Now that's how you that's how you would do it if you want to start by involving a risk-free asset right at the beginning. This is the so-called, this is kind of your efficient frontier. It's not much of a frontier. It's a straight line. Okay, but the concept is the same. I want to thank the person who asked this question. It seemed trivial, but when you turn the asset allocation process upside down and start with the risk-free asset, you actually get some pretty interesting concepts coming out at the other end. Okay, so I hope that was useful for making you think a little bit harder. I would prefer, for this question, interesting though it is, I would prefer just to stop it here, and I don't think. Please do not torture yourself by chasing it any further. All right. So that's question 2. Okay. Now I want to have a look at question number 3, which is this one here. Now this student was very kind to provided a diagram for me, and this is regarding what happens when you are only able to lend at one risk-free rate, but when you borrow at a higher risk-free rate. So we use the wonderfully exciting numbers of 5%, 9%. I probably wouldn't draw a diagram like this because your borrowing rate is even higher than one of the assets. Although it doesn't matter, but visually might be easier. I redrew this diagram somewhat. So now just spend a bit of time reading and digesting this question first. Okay, so this student is asking, they understand that if you are only able to borrow at 5%, then let's say if A is the optimal portfolio in that case, okay, then and then if you were only able to borrow at 9%, and then B becomes the optimal portfolio, then if you want to have a return, a target return, which is somewhere between these two, R1 and R2, should you lend or should you borrow? That's the question. Okay, so spend a moment just reading and thinking about it, and then I'll tell you the answer. Now, forgive me for I actually redrew. I think this is probably visually a closer resemblance to reality. So what I have is the efficient frontier, okay, and then I have here this is the curve, okay, and then forget about the 9% for now, okay. Now just take the 5%. So if the risk-free rate was, okay, first of all the curve. Let's look at the curve. The curve. What is the curve? The curve is the efficient frontier, which means you are fully invested, and I say there's no slack. Okay, there's no idle cash lying around being parked away in the risk-free asset. So you are 100% invested in the risky portfolio. If you were to do that, and if 5% is the risk-free rate, then clearly for a portfolio which is fully invested, this is the best point to be in. Okay. Now, if you are somewhat conservative, then you want to park away $30 in cash, then you would come down here. Okay. Coming down here means some of the money, $30 in cash, the other $70 would maintain the same investment weights that you have over here at this point. Okay, so the weights are the same, even though the money that you are risking is smaller. Okay, now the problem is if you like to have more risks and you actually want to borrow, then the borrowing rate is 9%. Now, for an investor who wants to borrow, this 5% line is no longer relevant. Just as for an investor who wants to lend money, the 9% line is not really relevant. For them, the world beyond this point, which is this line here, okay, this is supposed to be a straight line. This line here doesn't really exist, okay, because you cannot borrow money at 5%. So just forget about it. Okay. Now, likewise, for the investor who wants to lend, who wants to borrow, because the borrowing rate is 9%. So for an investor like that, the world to them would look like this line here, drawn from the 9% intercept, and then touching the same efficient frontier. So this would be the optimal portfolio to have. Okay, now, but I said they want to borrow, so they would actually go beyond. They would come down here. Now, likewise, for this kind of investor, okay, they cannot lend at 9%. Who said they could? They can't. You borrow at 9%. So for them, the line between this point here and here actually is meaningless. Okay, so you can say that your choices are either you go from here when you have zero risk, you go all the way up. Okay, if you really want to have a return between this is the return when I say is you are a market lender, okay, and this is the return beyond which you are a market borrower. If you want something in between, so the original question was, should you borrow or lend? Well, my answer is you can't do either, okay, because you can't lend at 5%, okay? Sorry, you can't borrow at 5%, okay? So this line here is not relevant, and you cannot lend to the market at 9%. Did I say that right? Okay, let me try. Let me start again. You cannot borrow at 5%. So forget about this line, okay? One. And you cannot put money to the market at 9%. So forget about this one, okay? So if you really want to have a target return here, you then have to be on this curve. Curve means from here going up like this. Okay, that is the only way. Because you wouldn't be climbing up this line, and you wouldn't be climbing down this line. Okay, now you can see immediately that if you had a portfolio which is somewhere on this curve, okay, just a quick visual inspection tells you that it would be somewhat inferior in terms of Sharpe ratio when you compare to the Sharpe ratio that you derive from this line here, from a 5% risk-free rate. Anything which bends the other way has to be less advantageous compared to the line, surely. Okay. So in other words, if you want to return somewhere here, okay, from the point of view of a Sharpe ratio driven by a 5% risk-free rate, your portfolio is going to be inferior. Okay. However, in a similar vein, you look at any portfolios that comes from this point down, is likely to be at least superior to, in terms of Sharpe ratio, it will be superior to any Sharpe ratio that you can derive in terms of a 9% risk-free rate. Okay, because the slope is getting steeper as you come down. Okay, so it depends on what your point of reference actually is. Okay. So I hope that helps in answering this question, and thank you very much for asking it. I appreciate, and always happy to hear from you. Thank you very much. Bye bye, and take care.